12 more days till Christmas, and today we're talking about hard money investing with the maestro, Mr. Know-It-All, Scott Hill.
Well, you're too kind on the know-it-all. I'm still working towards that. It's going to be a while, but thank you.
I know. Lisa knows more than you, and that's it doesn't say a lot, but it says a lot.
That's true.
Welcome back, Scott. How you been?
Hey, doing all right, man. Thanks for having me here. It's raining out, so nothing like having some good conversation about finances, right? Indoor stuff.
It's all about financial intelligence. Hence the name of our little channel.
That's right. That's right.
Today's topic is really cool though, because this is like something that you never know you needed it until you need it. A lot of people never know it's even an option until they're in a situation and it's presented to them, right? You're like, oh, well, shoot, yeah, this will really work for me, right?
Yeah, absolutely. A lot of times it's like last resort. People get into a transaction that they think is going to go smooth, and they find out they don't qualify. And there's still ways to solve that problem. In many cases with hard money. I like to say private money. Just sounds a lot easier off the tongue, especially for the listener.
Sure.
Yeah. I mean, when you're buying houses or flipping houses, or you're in some sort of financial difficulty, pulling money out with a hard money loan is a great answer, right? It's not cheap.
It serves a purpose. It's kind of like it's no different than in regular financing and conventional loans, right? I got a client today that needs to put 5% down and get a Fannie Mae loan, and they're kind of caught on that they have to have some PMI, some private mortgage insurance. And, it's all about psychology, getting them to understand, wait a minute. So you're going to pay $93 a month and you're going to leverage a property with 5% down. How long would it take you to save up the other 15%? And what would the home values do during that time? And then the light bulb goes off. So ever since I got into lending, I've been telling people there is a loan for every situation. What's your situation?
That's why you know the products, you know the services, you know everything else on it too, right?
That's right.
And it's, like I'm looking at buying a house in Vegas for my parents, and I'm like, how am I going to finance this? How am I going to do this? And, I can write out cash, but it's smarter for me to throw money into an investment, have that make money, and then pay off the loan slowly that way. I don't know. There's so many different ways to do it, right?
Yeah. No, very, very true. And, obviously the pursuit is to always get the funds as least expensive as you possibly can. But sometimes you just need funds, and it can be a short-term solution with a product that's a little bit more expensive, but the reward at the end of what you're going to earn by taking advantage of that investment is really what you need to be looking at, because you can always restructure financing. You can't always take advantage of an opportunity to pursue a piece of real estate that's right in front of you. So it's critical to understand that and separate the two, and that's why there's multiple levels of financing available out there, and a lot of people aren't aware of the private money or hard money sector.
Right. I think what could be really helpful, Scott, not to put you on the spot here, but if you could maybe give me or give us a couple of different scenarios, kind of the story of how you kind of gave a small one here briefly here. Maybe you can just walk us through maybe just a couple of different stories about how somebody would use private money in a situation. And then
sure.
Kind of the bolts and nuts of that, how that transaction looks and how it gets paid off and all that.
Sure. Let's talk about a common one, which is a scenario where someone wants to take advantage of an opportunity to buy a home. And let's say it's very competitive out there, and they've stumbled across a home they want. They currently own a property, trapped a lot of the equity that they actually need in order to purchase this next property. So this is where private money can come in and we call these bridge loans. And we're basically, what we're doing is, think of it like a bridge between two properties. We're essentially saying, hey, we know it's unlikely you're going to qualify for two giant mortgages at the same time, but we shouldn't preclude you from being able to access your equity somehow to take advantage of this opportunity. So let's add up the value of both properties. Let's subtract out anything you owe on the existing property that you're going to be departing from. And then let's make sure there's enough equity position in there, at least 30% or more typically. And then it's very likely, as long as your credit's not absolutely horrible, with no income, you're going to qualify for a bridge loan. And we call that, it's a private loan essentially. And these are investors that are pooling their money together. I'm sure we'll be talking about that a little bit here in a little bit. Accredited investors aggregating their funds together. And they're really looking at two things. They're looking at equity position, number one, and number two, exit strategy. How are you going to get out of this loan to pay us back?
Right.
Okay. Because this is money that they want to keep investing over and over again. Now, some might be okay with letting it sit for 12 months, 18 months, that kind of thing. But typically your private loans, they're going to go no more than 18 months. Your bridge loans up to 11 months, 11, 12 months, something like that. But that is one example, using bridge financing, so that the goal is get into this new property, buy it quickly. Typically, you can do this in 7 to 14 days. So now you're competitive with your offer, comparable to someone buying all cash. And then you simply go to someone like Vito and start getting your home ready to sell. And then you sell that property, take the equity out and pay off that bridge loan and have no loan at all, or you still need a loan. Then we just put a normal conventional loan on for the difference. That's one example of using private funds. And again, two things that come to mind: can't qualify traditionally, and I need speed. Okay, so those are two real big benefits right there. Another scenario could be you're about to purchase a piece of land, and someone started building, they got a foundation down, and they ran out of money. And they are having a hard time qualifying because they're self-employed and they write everything off. So traditionally, they're not showing a lot of taxable income here. But they're putting down 50%, but they show zero income on their tax returns. So that's the situation where a private investor is going to go, yeah, 50% down. We like the equity position. We're in. Don't really care about your income in that case. Now, oftentimes you'll still share your income, but it's not usually the deciding factor. It's, again, equity, exit strategy in most cases. So that's just another example. And usually the reason people do the hard money loans is traditionally because they need the speed of it to jump on an opportunity that's presented itself, and they just don't qualify. And third, this is one we haven't talked about. Some people don't want to deal with all the paperwork. There's very little paperwork. I mean, it's the easiest type of money you can get. You're typically going to have higher interest rates for sure, and you're going to. Now, remember, these investors aren't making a lot of their money long term, so it's short term. So they're going to be more fees up front in the form of points. That's where they're getting their most of their money. Okay.
And typically, like round numbers, what are you looking at? Like, I know it's a couple points and then a higher interest rate.
Right? Well, it's usually a little more than a couple. You'll see anywhere from typically 3 for a really good borrower up to 5, 6, depending on, like that scenario I just said. If if you got investors coming in on a half-built home, there's a lot of risk there, right? Sure. I mean, it's not a really good piece of property right there. Now, they envision it's going to be eventually. That's the goal. You've laid it out, but it's still not the greatest piece of property right now. So you're going to pay a lot more on something like that. Now, you've got a scenario where it's 70% equity in the property, phenomenal FICO scores. You're going to have some much better 30% cheaper on the interest rate, as well as maybe a couple points cheaper on the upfront points with the file. So yeah, those are three scenarios right there. So
Scott,
yeah,
question for you. What about somebody? That's great. Thank you for
yeah, you bet.
sharing and walking us through that.
Sure.
And I can see totally where, especially in the example you gave of somebody self-employed, or his cash flow varies, and so it's just challenging, right?
Yeah.
And this could be a perfect solution. What about somebody who say same person? Maybe they're just looking for uh, uh, they can't refinance easily,
Mm-hmm.
but they need to get some liquidity, right? So they're not trying to buy a new property or anything like that. They got a mortgage on the house, plenty of equity, and it's going to be a problem to refinance for whatever the reason is. But cash flow is decent and plenty of equity. This would also be something they could do.
Yeah, absolutely. I mean, you could have a traditional first mortgage with a really great interest rate that a lot of us got back in the 2020, 21, 22 timeframe, and you need a second mortgage, and you've got a lot of equity in your property, and you recently lost your job, but you got a bunch of money in the bank. So there's a perfect example. I need a quick private loan, maybe to fund something for my business, my self-employed business that I'm not showing income in, but I've got a long track record of being successful in this business, and I need some quick cash. That's a great example where a private loan would come in and fill that void, if you will. Yeah.
Got it. Yeah.
And then there's another step for that too. There's an investor loan that's out there where you can qualify the house just on the house, not the actual borrower, because it's an investment property.
Yeah, I think you're referring to the DSCR loans, the
DSCR.
Debt service coverage ratio loans, which really become extremely popular in the last couple of years. I got to tell you, it's a great product because a lot of people, again, they don't show traditional income for whatever reason. Many times they're self-employed. They write off a lot, or
they're a realtor,
yeah, or they have the ups and downs, and maybe the last few months, whatever they've been in hasn't brought in enough income, but they've got cash. They've got a great opportunity to buy a piece of property somewhere. And what's unique about the product is, hey, I can buy an investment property and kind of really focus in on the property more than focusing on me, the purchaser. So what's my payment going to be? What's the cash flow going to be? And what the lender's really looking for is cash flowing the property. I mean, you could really be showing no income at all, and they're going to give you a loan because it's kind of standing on its own merit of the property you're buying. And is it cash flowing? And they'll break it into percentages like 1.1, 1.25, 1.5. Like, what's the percentage of cash flow? Is the cash flow better than what you're paying? Then the terms will be a little bit better. Are you just barely breaking even? Then the terms might be a little worse. But you're capitalizing on the purchase. You're not having to show all your income. You can act quickly. And who's to say a couple years down the road, when you get your regular income back in line, pay it off, put a traditional Fannie Mae loan on there, and meanwhile your property's gone up $100,000, and you paid an extra $150 a month. Big deal for 24 months. Who cares? So great product, Vito, that you're talking about right there, and can do those in most states, which is great.
Can you do them in most states, or do you have to?
Yeah, that's the one area where, as a broker, I'm licensed in California, and so with DSCR, it doesn't follow the typical rules that we need to follow, and so the sources that we go through to fund these loans, we can use their licensing in those states and perform the loans, which is awesome.
Okay,
that's cool. I don't think I've ever heard of those loans. I've never heard of that.
And typically, you need 30%.
Yeah, you can get away with a little bit less sometimes, but typically 30 is where you need to be with most sources. And that's kind of where you need to be to make the numbers work, if you think about it, right? With the cost of way real estate's gone, and with the higher interest rate market that we're in right now. So it's not for someone with very little cash, but boy, it allows you to capitalize and not use hard money and the rates are pretty good. They're probably within 1 to 1.5% higher than a traditional loan. It's not horrible, and you can get them with prepayment penalties if you're willing to take on a prepayment penalty, meaning, hey, I'm not going to pay this loan off for a year or 2 years or what have you. Then the terms are going to be a little bit more friendly because they know they're going to capture a little bit more interest. So you can pick different products based on prepayment penalty scenarios.
Yeah. So like
So
a scenario. Go ahead.
I was going to say, so going back to the private money scenario, and just so so people can fully understand how that would work.
Yeah.
Right. So I have my home, situation comes up, don't want to go through traditional route. Reach out to Scott. He's able to find a private lender who looks at the situation and says, yeah, I'm going to lend you that money. Mm-hmm. Now that private lender will secure he has to protect themselves, right? So they're going to secure themselves as a lien holder on the home. Is that how that works?
So let's say the three of us right here, we're the investors, right? And we get presented this opportunity, right? The three of us are the ones that are going to pool our money together, and that's going to be aggregated by the individual, right? That's running that private lending company. And so they have a list of accredited investors, okay? And they're constantly throwing out opportunities in their inboxes. I got another one today. Some land here down in Gilroy. There's so much opportunity out there. It's not even funny. But then the person that is borrowing the funds is going to be receiving this loan essentially from the three of us, right? Mm-hmm. And we're going to start getting a check every single month. So sometimes you'll have one investor, just depends what the appetite is for that investment. Sometimes you have 5, 6, 7 investors. Mm-hmm. So sometimes it can get a little tricky on a really short close because the more investors you have, there could be somebody's a little delayed in getting their wire in or something. And so I always got to tell borrowers, hey, a little bit of a roller coaster here. We got 5 or 6, 7 investors, it sounds like. We don't want to write too short of an escrow because something could come up. But it usually goes through pretty smooth. And I'm actually an investor myself. And I like it.
That's why we're talking today. So the funny thing is, like, I just assumed that you were going to dump in your 25 or 500,000 or whatever the lump sum is into a pool of money, and then the advisor or the fund manager, I guess you could call it, would say, I'm going to push the button on this. It's different than that. You actually hold on to your money until you're like, I want in.
Correct. So I'm on both sides of it. Like, I'll see investments come through and I'm thinking like, hey, that looks like something that'd be good to invest in. But then I'm also putting these together for folks as well. So I see both sides of it. So I know how it works. And it's really, pretty simple. The investment comes out, it gets sent out, like I said, to hundreds, if not thousands of people. A complete outline of the investment, a little history on the borrower. Sometimes they'll mention, hey, this is a repeat borrower with us. They always pay back really well. Hey, the equity position's fantastic here. They need it for about 6 months. And of course, they're always saying, hey, what's the exit strategy? Oh, we're going to be selling this other piece of property and then we're going to be paying this off. And, this is going to be a 6 to 12 month loan or what have you. And then, the investors start emailing back. Yeah, hey, I'm in for 100,000 on that. Put me in for 200, And as soon as he gets it filled, he says, hey, thanks, this investment's closed. We have enough investors. And now they're back talking to the broker or the individual borrower who is borrowing the funds directly. Because sometimes these investors they've been doing this for years and they're just going direct to whatever source they want to go to out there. But anyway, that's kind of how it gets going. And then, the loan gets funded. And if you're an investor, you start receiving a check. And if you are the borrower, you're getting your funds traditionally just wired in, close an escrow, signing with the title company just like normal, and pretty smooth, pretty easy.
So when you dump the money into this fund, a deed and a promissory note is written by the investment company, and that's presented to the escrow and the buyer and the seller, and then everybody signs off on it, just like a traditional conventional loan.
Correct.
Except for they go to Fannie Mae, which is a tertiary market.
Correct.
So because it doesn't work with the Fannie Mae RESPA guidelines or what have you, it's a secondary market source of funds for you to fund loans for people that have issues. What is the back end? You know, I'm seeing things like 9%, 13% return on investment. Break that down for me. Who gets what? Let's just use like $1 million scenario.
So traditionally, the way a lot of the private lenders what they'll do is, I mean, it's a lot of work. You know, I talked to some of these guys, and you know, I mean, it's you got deals going on all over the country sometimes, you know, and it's a lot of hours. These guys that are aggregating all these investors together. But what typically will happen is there's a scale, like I said, on what's the loan to value, what position is the loan, first, second. Is it construction? Is it just purchase money? And so, you know, they'll look at that and scale it based on, okay, this is where the market is right now. It's going to be prime plus whatever based on credit score, you know, and loan to value primarily is what's driving it. Okay. And that can also drive the points a little bit in some cases. And so once that's determined, what a lot of private lenders will do is they'll put out that interest rate to the investors, and they might put that interest rate out at 0.5% lower than what they're actually charging the borrower. So that's their VIG, if you will. They'll themselves collect maybe 0.5% interest for themselves, with the majority of it going to the investors. Okay. And a lot of them will set up third-party servicing just to kind of handle, you know, all the payments to the investors and what have you. And yeah, it's pretty basic like that, you know, in general.
So I assume that you get like a sliding scale. Like,
yeah,
obviously, if you put $25,000 down, you're not going to get a large percentage. But if you're a standard investor, say I have $500,000 and I want to pop that down, my percentage is going to be more, I would assume, right? And
no, they're just piecing let's say we got 10 investors at $100,000 each.
Okay.
And the interest rate for that investment's 11.5%. One person's going to get $1 million at 11.5% invested, or 10 at 11.5% of 100,000. It's not about how much you put in. They keep it really simple.
They promise you 11.5%, and then those points up front, that goes to the investment company.
Correct.
Got it.
Correct. You're not getting the points as the investor. You're getting the return on interest.
Yeah. And
totally makes sense.
Because the person that's aggregating this, right, they're not making hardly anything on the interest. They're running.
They get their money up front. It becomes a storefront, basically.
That's correct.
Now,
that's their markup.
There's ways that because the qualifier here, right, is qualified investors, right? You got to have a certain amount of income or a certain amount of assets.
Yeah.
Which is actually more and more folks. However, there's a big part of the population who's not that. And there's ways they can participate in funds like this. However, they're expensive in that the expense costs and things like this are 1% to 2%. All right. And so you can still make, pretty decent return on these as a mom and pop investor. But that's just a different animal compared to what this is right here. And you can do so much more better as a qualified investor for sure.
Yeah, I'll give you an example. So I had $250,000 invested at one time. That 200 got paid off, and I had another small loan for 50,000. And at the time, this is when rates were really high, and I got in at 14%. So $50,000, simple math, times 14%. Is $7,000 a year, divided by 12. I get a check for $583 0.33 every month. Have been for about the last 17 months. Like clockwork. Envelope lands in my mailbox every month.
That's
Equity
awesome.
position was like 40.
Yeah.
Where are you going to get that?
That's right.
The key
Not
is to
in,
make sure
not in the stock market.
Yeah, make sure you vet out the company and that they are making good decisions on behalf of the investors, right?
Right. Because there's going to be some that do fall through.
But if they're good and they know what they're doing, they've been doing it a long time, it's very small.
Yeah.
That's why the equity position's got to be good, because who's going to walk away from that when that equity position's really good? Very few people.
And when you mean equity position, you're talking about first or second lien. If it's a second lien based on a first, then that group of people that invest in that property and happens to go into foreclosure, they have to agree to refinance or figure out how to pay off that first lien.
Well, I'm just talking about the property itself, the collateral. If they're going to be borrowing $600,000 and the property is appraised, because they're going to appraise these properties or do BPOs on them sometimes, broker price opinion, right?
I used to do those.
There's 40% equity here. Okay. The borrower's got their act together. It makes sense why they need the money. They provided a clear exit strategy. Who's in?
Yeah.
That easy.
It's highly unlikely that person who owns that property is going to walk away from it, right?
That's correct.
Yeah.
And if you're in first position, Patrick, if this loan is in first position and they go to foreclose or deed in lieu, which is basically the buyers giving it back to the bank, which is the bank, the investors, you don't lose anything, because now you have not only the equity position, but you also have 1/10 or whatever percentage of that property, and then you go to secondary. We go back on the MLS.
Well, no, wait a second. Make sure I understand the same thing, because I think what I heard from Scott was, the first. This is a situation where somebody probably has. Well, if the property's paid off, that's right.
Right.
If there's a loan on the property, though, you're coming in the second position.
Yeah.
Well, that's something you have to be aware of. And as an investor, when you're going into this, you have to understand, if you're in second position and there's $500 million or $5 million or $500,000, that house goes into foreclosure. Every one of those investors that are in second position, they have to belly up to buy that first loan and satisfy it and pull them out of foreclosure.
Well,
or they lose their money.
Well, yeah. And so if a private lender is going to lend in second position, you can bet that the rate's going to be higher, the points are going to be higher, and the equity position needed is going to be higher.
Right.
Because they're going to earn more money, because it's just like putting it in the stock market at a really risky investment, or I'm going to go in bonds, right? And so who's willing to go into this risky investment in second position, but the equity's pretty good? Maybe this person has a track record of doing this over and over again as a borrower of funds and has always paid back faithfully. Yeah, you're going to get people that are going to invest their money in that.
Right. It's a win-win situation where the person leading the money, they have equity, just can't get money as fast as they need at the time.
That's right.
The investors come in second place, in second position, which is riskier. However, you're not going to do that unless there's plenty of equity. And so in the worst case scenario, you get your money back. It might be a little bit more, high maintenance to do it. However, you're more likely than not going to recoup what you put in.
Yeah, and first position is going to get paid off first. That's why anyone coming in second is going to go, all right, there's still a ton of equity for me still to get paid off as well. Right. That's why they're leaving, say, 40% equity right out of the gate, right? I'm going to get my money back. A high likelihood that's going to happen, because you're not going to see going in second position up to 70, 75% loan to value. Not, that private lenders playing with dynamite. He wouldn't do that,
Sure.
But yeah. So
my brain's racing right now. I'm like, I don't know how much money do I need to put down? Let's get going.
No, I worked with somebody who was doing a lot of this in the early 2000s and was mostly catering towards people who needed a second. So coming in second position. At that time, he's probably making, I want to say, somewhere between 8 and 12% on the loans, and interest only, right? And we get paid off through refinances whenever the time was right. And then, of course, 2008 and 2009 happened, and so there was a lot of there was some losses there, but none of that compared to what he made, though, right?
Yeah.
And fast forward years later, some of those folks who stopped paying, guess what? 10 years later, they had to refinance and they still had to pay, right?
That's right.
So they still had to pay. There's no way around it, whether they sell it or refinance, which in California, you're going to do that at some point. For most folks, anyways. Even in those worser case scenarios where it doesn't work out exactly as planned for the investor, it's still more likely not going to work out.
That's right.
Yeah,
that's right.
And it's a win-win. Like I said, it's also good for the person who needs the money. And that's what you would want, right?
Yes.
Win-win situation for everybody.
So, Patrick, I don't know what my fund's doing with you, and it's doing really well. So pat yourself on the back, first of all. But compare and contrast this opportunity to what you're doing with me, which is the ETFs, I think, right? I'm totally freaking ignorant with stock market.
Well, I mean, I think I understand what you're asking, and there are different strategies. I often get asked, what should I do, or compare this to that. It's not either or. It's usually and. You should do this and you should do that. The question is how much you should do it with, right? The challenge sometimes that can come up in this type of investing, as phenomenal as it is like, man, I'm starting to get a tax problem, right? All this is taxable income.
But paying taxes is good. I mean, and there's other things you can do to offset that by buying businesses or buying investments, et cetera, right?
Yeah, absolutely. So all I'm saying is, it depends on what you're doing it and where you're doing it at. So as an example, hard to do these things in retirement plans, right? It's really hard, almost impossible.
Yeah, I looked into it. I got the same answer.
Yeah.
I was like, hey, this is what I want to do. Can I put all this in?
Yeah.
No.
You can't.
Right? So, you got to figure out where you can play and where you can't play with these kind of things. Now, I think that'll change here in the future, though, because the need for retirement returns for Americans is pretty high, and so I think you're going to start seeing a lot of loosening of those restrictions. I don't know that's going to happen, but I believe it's going to happen. Over the next 5 to 10 years.
You get a lot of people that just got a lot of money on the sidelines. They've maxed out their retirement. They maybe sold a piece of property, and they just want a no hassle, no nonsense form of monthly cash flow.
Right.
And if you think about it, you could literally do this over a year, collect all the interest, get paid off. Now you turn around and you take the original principal plus the new funds you've earned, if you're disciplined, and then now reinvest that and just keep redoing that year after year and growing that as well. I don't think people should not do their retirement planning with a good financial planner. That's the number one thing they should be doing. This is something alternative that people can do because it can bolster your retirement goals, pretty safely,
Yeah.
But you also have to be pretty proactive about it, right? I mean, with what I'm doing with Patrick is very passive. He sends me these automated, company profile things. I'm like, I don't know, whatever. You just do it. I don't want to look at it. And that's, I'm a dream client for him because I just give him money and he gets to play with whatever he, not like it's billions of dollars or millions of dollars, but it's, it's something.
That's right.
But with this, you actually have to be fairly proactive. You have to do the due diligence yourself.
You do. And depending on who you're working with, I'm talking about, the people that run these hard money companies. You want to make sure, you know what they're all about. And if you've done it long enough, you eventually just trust their discernment on these investments because they don't want anything to go belly up because it's a bad mark on them. So if their track record's pretty good, you just start trusting them. You're not going to go out and look at all the properties yourself. And I mean, you can, sure. That investment might be gone by the time you went and have done all that because he's go pretty quick. But you can definitely do that, not a problem. But most people just look at the profile of what's been sent out. They even sent out, with the borrower's permission, a credit report to review. Okay. sometimes an appraisal, if they've had one done, they provide a due diligence package to the investors that is pretty top notch for you to make a decision without having to go look at the property. Photos, the Zillow link, a lot of times, it's pretty cool.
Scott, typically most of these companies like this will have like minimums. Is that something that's
Yeah.
true, or what's that look
Yeah, I think minimums would probably be maybe 25,000, something like that, 25, 50,000.
But look, guys, I mean, if somebody's out there saying, "Oh, I want to get into flipping houses, but I just don't have 20% down and the cash to hold it and the cash to fix it," this is a great opportunity. If you have $25,000, you can build that into a down payment and holding costs and fixing repair costs.
That's right.
And then do your flipping, right? And
absolutely.
It's being my age. I think I'm older than you two, both of you. Being at my age,
I'm the youngest person on this podcast, by the way.
Yeah, fuck off.
The youngest person.
I think we're all.
I don't get to say that too many times anymore.
The youngest for sure.
Those times I get to say that are slim.
The last thing I want to do is pick up my hammer and do a repair on a fixer flipper. And I look at fix and flip houses and I make fun of them on my videos because the people that do them do a crappy job, and you can tell. Most of them. There's some really decent ones. You have to look a little bit harder. But that's the last thing I want to do. And being in a business mindset versus being an employee or a service provider mindset where you're doing everything, right? As a loan professional, as a financial advisor, as a realtor, you're doing everything. You're not a business owner in the sense that you can't scale your skill set out. This is something where you're actually investing money. So if you look at Kiyosaki's 4-quadrant, you're in the 4th quadrant with this.
That's right.
Yeah.
And people make fun of his quadrant thing, but it's a great mindset to have, because the last thing you want to do as you get older is to have to pick up a freaking hammer and buy a fix and flip.
Yeah.
Right. So, and this doesn't just equate to residential. It's also commercial, right?
That's right. Commercial as well. You got it.
Yeah.
They look at that at all.
I'm excited.
Do you want to talk a little bit about what the requirements would be to be an investor?
After this,
Yeah.
Okay.
I have a scenario I want to push to you. I sell my house. I get $1 million in equity, and I go to buy my parents a house in Vegas for $500,000. Instead of putting cash down, I put 20% down, and I take that $400,000. That's 80% of 500, and invest it in this. The Las Vegas loan is 7%. I'm getting 9 or 10 or 11% on this. It's making money for me. Instead of, I become the bank, basically.
Correct. You're arbitraging, right? And you're leveraging that asset. That property is growing still, whether you sunk all your money into it or not. So the decision you just made is growing your net worth faster, as long as the interest performs on the investment that you stick the $400,000 into.
Right. And I do the same thing for the next house I buy. I buy it 80% down here, $2 million house, and then I sink the rest of that money into something that's going to make money for me, so it pays off my loan.
Or maybe you take 200,000 of the 400 and give it to Patrick to do something. So you diversify, and then 200 into one of these investments, and now you feel really diversified and safe.
I'm pretty diversified with Patrick right now, so I'm happy with that. We're going to give him more at the end of the year, but yeah.
But theoretically, Vito, yes. I mean, if you can make more money somewhere else, but then you got to just understand what are the tax implications of the different investments and that kind of thing, of course. Again,
it's mitigated through different ways. I mean, that's what my accountant guy does. I tell him to go make me show that I only make $25,000 a year, so I don't have to pay income tax. Never happens.
You start asking me tax questions. That's not going to be my wheelhouse at all.
Yeah.
That would be more Patrick here.
So you can invest.
But to your point, or I think you were getting ready to get into the qualifications here, going back to what I was saying about how I think a lot of these things will be changing in the coming years. For a long time, the accredited investor it is what it was, or it is what it is. Like there was no way around it. They recently opened that up to certain financial professionals. You don't have to have the assets or the income, as long as you have the expertise, quote unquote. You are considered a accredited investor. I think we're gonna see that list expand and see more and more professionals, whether it's real estate or mortgage lending. If you have expertise in finance in some way, shape, or form, I think you're going to see those people added to those as well.
No, it's true. It's true. So I kind of put together just a little list here, kind of the latest info on how you can become an accredited investor. First of all, you got to fill out the 2-page form with anybody that you're going to.
We're losing you.
870 RE870. Okay, and it's a questionnaire that helps them determine your availability to do this. So let's talk about an individual. Okay, the income test. An individual must have an annual income exceeding $200,000 in each of the last 2 years, or $300,000 if you're combining with a spouse. Okay, and there has to be an expectation that that's going to continue in the current year. Kind of like a P&L, if you will, right? You can't be, hey, I'm falling off the cliff this year, but hey, I was good last year and the year before, right? Or a net worth test. An individual must have a net worth exceeding $1 million. This is important. Excluding the value of their primary residence.
Yeah, that's a big one.
The net worth is determined by the value of all assets, including investments, real estate, and other property, minus liabilities, including mortgages and other debts. Okay, so can't count your primary residence in there. Just like Kiyosaki, right? He always said your primary residence was a liability, not an asset, right?
Right. Yeah.
So there's the Kiyosaki part right there. Let's talk about entity. Okay, entities, corporations, partnerships, LLCs, trusts may qualify as accredited investors if they meet the following conditions: assets of $5 million or more, and the entity was not formed for the specific purpose of acquiring the securities being offered. Ownership by accredited investors. If all equity owners of the entity are accredited investors, the entity itself may qualify. Banks, insurance companies, registered investment companies, business development companies, and small business investment companies are also automatically considered accredited investors. Okay, that part of it will not be my wheelhouse. I'm an individual, but I wanted to put all this out there for you guys. And then to Patrick's point, professional certifications. Certain professionals, such as licensed financial professionals, for example, brokers, investment advisors with a Series 7, Series 65, or Series 82 license, may also be considered accredited investors based on their professional knowledge. The criteria are established under Rule 501 of Regulation D of the Securities Act of 1933 and are subject to changes or updates by the SEC.
And that's a new one.
And then the additional notes here. All right, this is good. Again, primary residence exclusion. The value of an individual's primary residence is excluded from the net worth calculation, although mortgages and other related liabilities are included in the calculation of net worth. And then sophistication requirement. This totally blows you out, Vito.
I'll just sit here and eat my crayons.
While the SEC uses financial criteria as the primary basis for defining accredited investors, the underlying principle is that these individuals or entities can bear the risks of more sophisticated investments. And then I put an asterisk here. Being an accredited investor enables participation in investment opportunities that are otherwise not available to the general public, often involving high risk, but also potentially higher returns. There you have it.
There you have it. Yeah. Which is the same, or not the same. Well, two things. One, like the professional designation stuff, that stuff is new. I want to say it's only the last 2 years.
Yeah.
Before that, it was just strictly, income and assets. So I do think that list will get expanded. If you think about $300,000, depending on the state or the city you live in, that's a lot of couples. That's a lot of folks out there, right? They may not qualify on the asset part yet, especially if they're younger. However, think of the Bay Area, man, that's a lot of folks for sure.
Yeah.
They just probably don't realize they can do this.
Mm-hmm.
Yeah.
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 There's also a lot of private, we're talking about the private money side. It's the same qualifications to get into private equity, right? To get into those things before they become IPOs. You got to be a credit investor and so forth. And
you don't have to be a qualified investor, though, an accredited investor, do you? I mean, there's certain places that'll give you can put $25,000
in a private offering.
Yeah, I was looking at. There's a couple other places out there that'll offer it to non-qualified investors.
I'm not sure. Well, there's trying to think what that might be.
Remember last year we were talking about the difference between REITs and syndicates. You can only be an investor in a syndicate if you're.
Oh well, a REIT. So about a REIT you can invest in as an accredited investor, but that's not private equity. That's a publicly exchanged thing.
Right.
Private equity, you're trying to get into something that it's early before it's gone public. Like big examples like a Facebook, for example. Before it went public, it was all private equity, and then it went public. The challenge now is though, so many companies have done this, and all the people making money are the ones who got in on that IPO, right? And so all
it's
those
a big Ponzi scheme, right? It's a big pyramid scheme.
Well, I wouldn't say that, but
I would.
There's so many returns. There's so many people getting locked out of that, and so going back to what I said earlier, there's a lot of Americans with retirement accounts that are too low to get locked out. A lot of this stuff. So I think we're going to be seeing ways where the marketplace is going to provide a way for those folks to get in on those IPOs as well. So we'll see. But having said that, this is an awesome opportunity right here. I mean, this is a great way for people to diversify their income, especially if they got cash sitting on the side. People who sell a second home or come into inheritance or get bought out at work, or the list goes on and on and on. What a great way to create.
I kind of look at it like a CD in a sense, especially when a bridge loan opportunity comes out, and you've got some money. Sizable amount of money sitting somewhere that you're not purchasing a piece of property for 9 months, 12 months. And someone that's getting a bridge loan needs a bridge loan because they're trying to sell their other property. So there's a high level of motivation for them to get out of that bridge loan in 3 to 4 months. And you're going to get your money back pretty quick. Now, obviously it's not as guaranteed as a CD because they're going to give that person 11 months just in case, but they're usually
only making 1%.
Right.
Yeah, but the return is better.
Yeah. Sure. So I'm willing to, if I don't need the money for 9 months and I know they're high probability it's getting paid off in 4, 5 the most, that's still buffering another 35, 40% of time that I'm going to get my money back and have made some money off that.
That's right. And even in an interest rate environment where people can get 4 or 5% on their cash right now, which sounds pretty good compared to what it was for a long time, interest rates are starting to trickle back down. And in this kind of opportunity, interest rates don't trickle back down very much, right?
Yeah.
They're going to still remain high.
They go up faster than they come down.
That's right. That's right.
That's a good point, Patrick. That's absolutely the truth.
Yeah.
A lot of them are tied to prime though, so they will come down a little bit. But prime's only come down 3/4 in the last. Started in summertime, right? Somewhere in the summertime, they did the half and then a quarter. So it's still pretty robust. I guess would be.
And for somebody who's looking for, if I'm in a situation where I know I have the equity, I need money fast for another opportunity, this is an excellent solution right here.
Yeah. No
So
doubt
you
about
two
it.
need to get together and kibbutz and get your clients together with this, because I don't know. Is it like an MLM where you get credit if you refer me to this company?
I don't think most of them don't have that. I don't think they want to get involved in that kind of a thing. Not that I know of. I've never met anyone that does that. Not to say it doesn't exist, but
I think I try to avoid those ones too.
talk offline about stuff, but typically I haven't seen that. Yeah.
Well, Scott, if we have somebody, I know somebody can reach out to you if they're looking for a private lender, right? We can come to you, and that's an opportunity that you can help with.
Absolutely. It's a game changer for a lot of folks, you know, and I'm glad you guys wanted to do this today, because this recording is going to help a lot of people who are on either side of that fence. They need money, or they want to get involved and don't realize it's another form of investing.
Yeah.
But it is a game changer for somebody that needs funding. It takes a little bit of education. They got to get over the interest rates, 3 to 4% higher. Yeah, it's short term though. Yeah, it's going to cost me a little bit more upfront, but look what it costs to pay a real estate agent every time you buy or sell a property, right? So it's just another transaction. You're still in that same range of cost, but you're now able to jump on an opportunity that is going to be something you wouldn't be able to do without the funds. And so I enjoyed the back and forth today, guys. A lot of good info here for the viewers.
I want to put it out there that I pride myself for negotiating the price so high that I pay for my own commission.
Yeah.
I just did it again today. I had a house. It's been on the market for a long time because there are two trustees fighting over whatever. Finally got it back on the market and got loans, and it went from 1.5 up to 1.7, and then I pushed it after everything was up. My job is to break the buyers, right? I pushed it up to 1.82. So the value that I brought was my pit bull negotiating afterwards. So yeah, it costs money to make money, but I make you a whole lot more. And at the end of the day, I negotiate for myself to be paid by that extra percentage that I get for you.
Yeah.
No, that's why I think that it's a win-win scenario. There's a reason why the interest rates are higher, and because the scenario is different, and it is a win for everybody involved, for sure. Yeah, this is awesome. Thanks, Scott, man. This is a great walkthrough. Appreciate it.
Oh, you bet. Thanks, guys. Great questions. Good stuff. Thanks, Vito.
I'll be talking to you in the beginning of the year for this, and we'll talk more about it, because I
just need to get a little bit more sophisticated first.
Well, I'm the crayon eater, so
yeah.
The last thing we should say is our predictions for the football game this weekend.
Look, Army took the last one. They're going to take this one.
Wait. I heard Army is playing Navy, and the Marines are supplying the cheerleaders.
That's right.
That's right. I heard, right?
YMCA.
That's right.
They're playing the band. They're in the band.
That's right.
Hey, don't mock the band. I've been a band dad for the last
Bands
3 years.
Pretty serious. They are.
I'm gonna leave it alone then.
Hey, I've seen the band make a tackle before in the old big game, right?
Yeah, you don't mess with the band.
Cal
They'll knock
Stanford.
you out.
Awesome.
Right on, guys.
The little drum major guys. Hey, thanks a lot. I think this is it for the year. So Merry Christmas and Happy Hanukkah and Kwanzaa and all that. And thanks for watching, everybody.
Absolutely. Appreciate it. Everybody have a good one. Merry Christmas.
Yeah.
All that.